Welcome to the Money Tales podcast. I'm Cammie Doder.
And I'm Sandy Brager. Cammie, I'm so excited that we have Barry Ritholtz joining us today. We get to talk about him, his life, his relationship with money, and his latest book, which is called How Not to Invest. And that got me thinking, reading the book, what is your biggest money mistake when it comes to investing?
Oh gosh, Sandy, there's so many. But what comes to mind when you ask that is my brothers and I decided to invest some money together during the dot-com boom. But we didn't know it was the dot-com boom. We just knew that everyone around us seemed like they were getting wealthier and wealthier and making these great investments. So we said, well, we can do that. And then what's the saying? A rising tide lifts all boats.
Yes.
Because we were like, this is so easy. And my brother at the time his back was out, so he's watching all the news programs. And he would email us, I think. I don't think we were texting back then, right? He was emailing us his ideas, and he's a really thoughtful, he does research, but it was often prompted by something he saw on TV. And so we were just doing great until we weren't. And the bust happened. I'll tell you, that's such an important lesson. There's so many lessons in there. One, diversification. Two, don't
beware
chase
of FOMO.
FOMO, chasing. So Barry writes about this, the news programs and them telling me, you got to get into XYZ. I'll tell you what, an important lesson. It was an expensive lesson, but maybe it's priceless because it saved us from doing it at other times. How about you, Sandy? What's your answer?
My biggest investing mistake happened when I was starting my career. It's 1993. I was 21 years old, got my first real job, was sitting in an orientation and had to fill out my 401k paperwork. I knew enough to contribute as much as I could afford at the time, but I had no idea about investing, and I just didn't know what to do. And the HR person in the room gave us some really great hot tips, right? She said, most people diversify. They just divide up their contributions among all the investments that are available in the plan. So I had something like, a 25% allocation to bonds as like a 21-year-old who's not going to touch this money for decades. So that was a good learning for me of, be careful about where you take your investment advice. And certainly as I got to learn about investments as I progressed in my career and changed toward wealth management, I've learned to really appreciate that lesson even more.
It's so important to talk about these mistakes because it does. We normalize them. And then that felt cathartic to me to share that story. And I don't know about you. Well, it's my pleasure to turn our conversation to our guest, Barry Ritholtz. It is fantastic to be talking with you on Money Tales.
Well, it's fantastic to be here. Thanks for having me.
Let's start by telling us a bit about yourself, your background, and would you highlight a couple key events or decisions that have been instrumental in shaping who you are?
Sure. So I'm Barry Ritholtz. I'm founder, chief investment officer, and chairman of Ritholtz Wealth Management. I have a couple of side hustles, but throughout all of these things, I describe my job as making complex financial issues understandable so people can make better decisions. And that includes whether it's the financial crisis or just basic portfolio allocation. The side hustles are I'm host of Bloomberg's Masters in Business podcast, which is now in its 11th year, over 500 episodes. That was literally the first Bloomberg podcast, and they have since podcastified, and I'll take a little credit for that. Previously, I was investing in financial columnist for the Washington Post, now at Bloomberg. I wrote the book Bailout Nation to explain how the great financial crisis came about. And my new book is How Not to Invest, the bad ideas, numbers, and behavior that destroys wealth. And it comes back to the same two issues. How do you make the complex understandable? And how can you use that knowledge to make better decisions? So that's my long-winded introduction. 2 or 3 pivotal moments that help explain who I am. have an odd background. I was originally applied math and physics and then went to law school. Loved law school, hated the practice of law, and eventually found my way to a trading desk at a friend's firm, and that led to a career in finance. When I was on the trading desk with a minimum of training, where they kind of throw you in the deep end of the pool and whoever doesn't drown becomes a trader, I first of all, I love trading, and I was self-aware enough to recognize that always looking for a vein, looking for that dopamine hit. So I had I'm normally pretty oblivious, but I had a little bit of insight like, hey, you're doing this more for fun, not for P&L. But the aha moment, which sort of sent me on a specific course, was you're on a long desk of a whole bunch of traders, mostly guys, not all guys, but back in the 90s, it was mostly dudes. And I was fascinated. How come the guy next to me is killing it this week? He's making so much money. And the guy on the other side of me is just getting demolished. Whatever he touches turns to crap. And then the following week, the roles reversed. And suddenly, Mr. Can't Lose can't, find his way out of a wet paper bag. And the bum is constantly killing it. And, I found a book in the mid-90s before behavioral finance was really a big thing, by a Cornell professor named Thomas Gilovich. I think his book, How We Know What Isn't So, was the first mainstream behavioral finance book. And it was manna from heaven. That book was, or at least the first 2/3 of it, are really psychology based. And you realize how little we know about what's going around us, how a lot of our decisions are hardwired into us. We think we're exercising free will when we're just responding to stimuli, and on this goes. And so that sent me down a rabbit hole, eventually to Kahneman and Tversky and Thaler and Schiller, and on to the pantheon of true behavioral finance things. But to bring it back to the rom-com thing, one of the things we learn in behavioral finance is, how old is the human race? Depending on which anthropologist you speak to, 2 million years, 1.5 million years. The modern brain, 200 to 400,000 years. For most of human history, humanity was not literate. We couldn't read or write. In fact, even when the printing press was invented by Gutenberg in whenever, the 1600s, 3%, 2% of the population, the kings, the nobles, the church, they could read. The average person, the merchant class, the peasants, the farmers, they couldn't read. So how do you communicate between people, down through generations? How do you tell people, hey, don't eat this berry, don't stay away from that snake, they're both toxic. Here's when these animals will come near us so you can use them for hunting. When do you have to be aware of the river rising? Like all of these survival existential threats, you couldn't write a list and leave it for the next generation. They were passed down from story to story, generation to generation. And so we have a predilection to want narratives. And that leads us to some bad decision-making things. We love a good story where it's black and white, and there's good guys and bad guys, and here's the conflict, and here's how it's resolved, and then the denouement, the whole Campbell's hero's journey and all of that. But it's not how the real world works. The real world isn't a rom-com. Data matters, facts matters, things that look one way but really are different often lead us to misunderstanding the world around us and to making bad decisions. And so that was a seminal moment. As much as I want to argue that, hey, that's a great narrative, and here's the eureka moment.
I'm
jumping
hearing all
out
the
of the
music,
tub,
Barry, as you're talking,
right?
like the lights coming on.
Right. But in reality, it was a long, gradual process. And at the time, there was no eureka. It was just like, this doesn't. So trading desks are notorious for lore, for trading aphorisms and rules. And, in the book, I talk about, why is 20% a bear market? Why? So I researched it. I looked all over. And the short answer is it's bullshit. It's made up. It's made up by pundits. It's made up by the media. It's nonsense. But you know what? It's a rule of thumb, and people like, oh, okay, we're in a bear market now. How does that help you? Does that help you? Does it, if you sell when we're down 20%? No, that turns out to be a terrible idea. You should be a buyer down 20%, even though it might be down 34%, like it was in Q1 2020. And so once you start this process of, hey, I have to go back to first principles and think about why we believe what we believe. And as often as not, the reason we believe stuff is nonsensical. And that leads to poor decision making.
For sure. All right. This is a evolving, I appreciate it. It's a tapestry. My husband talks a lot about that. It builds. And it's super important. But going back to first principles, tell us your backstory. When you were growing up, how did you connect with money? What was going on?
So it's funny. I just had I have two siblings. I'm the oldest. My sister's about 2.5 years younger than me. My brother's about 8.5 years younger than me. And we were kind of laughing that the three of us in the same household grew up in very different financial circumstances. So my dad's boss suddenly dropped dead and the whole business collapsed. And he had a scramble to find work. I have a vivid recollection of this in the 70s when it's tough finding work in that era. And I grew up pretty hard scrabble, like lower middle class. Now, let me just caveat this. If you're poor and you're like suburban Long Island poor, where mom was a real estate agent and dad formerly was a white collar worker who eventually launched a sporting goods store, like there's poor and then there's poor. That's like not the worst poor, but I remember money always being tight. I went to a state school that I worked and paid for myself. I paid for law school myself. So it was very hard scrabble. By the time I'm in college and my sister's in high school, like things were a little easier. And my brother has no idea what it's like to be poor because by the time he's in high school, the store was doing well, the economy was doing better, everything was so like the three of us each had a different upbringing. And the way that affected how I look at money, first, I was a lawyer and my angel of a wife thought she was marrying a lawyer, so there would be financial stability. She was an art teacher, very successful, had a great career for 30-something years. She introduced at the high school level teaching fashion illustration and design. I begged her to write a book 20 years ago about this because now half the schools in the country have a program like that. She was one of the first. And, she thought she was marrying a stable lawyer and she married someone who was about to throw all that away, switch careers. And the first 10 years in finance are really tough, especially for someone who doesn't want to be a salesperson or a broker. So I felt like I was making much less than my peers who stayed in law and had moved up the pyramid. I mean, I love law school. I hated being a lawyer. It's just, hey, my blog is called The Big Picture, and I am not a detail, minutia sort of guy. I don't want to balance a checkbook. I keep a running total in my head. I don't want to do my own taxes. It's that is not my strength. 10,000 foot view, big picture, for sure. But very much I felt like I was behind where my peers were, at least for the first 10 years in finance. And I kind of started to call out. I started kind of noticing what I call pain points with money. And what's a pain point with money? I have this vivid recollection of being in the supermarket with my wife. By the way, she hates shopping in the supermarket. It's a playground for me. I have fun. It's a running, diatribe, making fun of really stupid product names. And it's just fun. And she was kind of back when we were pretty hard scrabble, when money was tight. She was agonizing between not even the Rouse marinara sauce, but between the like crappy store brand and the medium thing. And this was about, I want to say this was like mid 2000s. I was starting to make some money. People were starting to have a sense of who I was. I've been writing in public for about 7 years by then. And again, the running total, the being facile with numbers, I said to her, buy the most expensive sauce. If you do that for every item in the supermarket, we can afford it because we're not as broke as we were when I switched careers 10 years ago. And what are we spending a month in the grocery store? $1,000. If you buy the most expensive item, maybe it's $2,000. We can swing that. And suddenly I started to notice people have pain points everywhere. So I'll give you some of my.
Yeah, I appreciate you bringing this up. Yeah.
I'll give you my favorite examples. So I am hard on clothes. You know, my wife always says, whatever you buy, make sure it's Barry proof. Some of it is because I just don't pay attention to what I do, and I get caught on a nail doing something, or I'll spill food on me, or like I'm not slow down, pay attention. I heard that my whole life, and I just don't. I'm kind of oblivious. So I noticed I have all right. So now food isn't a pain point. What about going out to eat? Well, when you're young and broke, you go to cheap and cheerful restaurants. You start making a little money, you go out to nicer places for anniversaries or birthdays or today's Valentine's Day. So I have another vivid recollection. We went to this restaurant, no longer around, called Mirepoix, and we ordered some specials off the menu without asking the price. And I was shocked when this special floating vodka drink was $25. This was our 5th anniversary. I'm married for 30 years. So this is 25 years ago. Imagine like a mixed drink today is $20, but 25 years ago. So suddenly a few years go by and suddenly going out to a nice restaurant isn't just special occasions. It's Friday night date night. Where do you want to go? Pick a place. It doesn't matter. That pain point went away. The clothing pain point, for the most part, went away. You could buy, short of couture, I could go into Nordstrom's and buy anything. Barry shouldn't really be wearing $400 shirts because they'll eventually be $400 bibs. But still, these new stretch jeans, are a little nicer than the Levi's you've been wearing. Hey, they're $175. Just shut up and buy it. You spent $300 on dinner last night. So clothes went away as a pain point.
You were able to get over your pain points, which is hard for some people.
Well, as you progress through time, as you mature in your career, and as some of your expenses shift, like when you first buy a house, it's a little bit of a reach. And then a few years later, it's like, we can easily afford what we thought was a reach. You're making a little more money year by year, hopefully more than inflation goes. So vacations were a pain point. Like, who the hell spends 10 grand on a vacation? You start making enough money. I'm looking out my home office window. There's half a foot of snow outside. It would be nice to go to the Caribbean. And so as we progress through our lives, eventually it's cars. I don't know when people reach the point where you could go buy any house and there's no pain point, especially where we live. It's insane. So taking complex questions about what should I spend time on? And the takeaway for that is it's not about the widget. It's not about the gadget, whatever the gadget happens to be. It's about the time and experiences that thing can generate. So if he would have bought like a 25-foot day runner where he could take the family out and they could go picnic out on the beach or whatever, or take the boat to a restaurant or whatever, he would have been fine. He just didn't understand his own use case for the boat. But we see this in everything. We see this in people's spending. We see it in how they spend their time, and we see it in their portfolios. Like, why you mentioned this earlier. Why does a 21-year-old have any bonds? You have a 45, 50-year time horizon. As long as you can tolerate the volatility, why should you have bonds in your portfolio?
Go ahead, make me feel worse than I already do, Barry. But you're right. But we don't provide enough financial education, and we don't provide enough opportunities, I think, for people to engage in money conversations. So I really appreciate what you're saying and in your ability to simplify things. I'm wondering, though, in the space that we all work in financial services, there's so much complexity that the that the industry puts out there, whether it's the language, the concepts. And I'm curious, how did that become so? Because I think that's a huge barrier in front of most people. It turns them off. They don't want to engage about money because they feel stupid. They can't even understand the language.
Right. So first, youth is when you should make mistakes. There's this very odd phenomena, and I don't want to keep referencing the book, but there's a chapter in the book about the bear markets that mattered the least to me felt like they were the worst. And the ones that mattered the most, you kind of shrug off. So in the 1990s, when my 401k was, four figures, and my wife's 403b was barely five figures, every bear market felt horrible. The 2000 crash felt horrible. 9/11 and the aftermath felt terrible. From a financial perspective, from an emotional perspective, from a financial perspective, who cares if your $8,000 401k is down 40%? It's meaningless. On the other hand, fast forward 25 years later, every bear market where not only do I have a real portfolio and a real 401k, my entire business is dependent on what the market does. And every time there's a crash or a drawdown, or it matters so little, because the thought process is, I've seen this movie, I know how it ends, this too shall pass. And so there's some of that. I love the Howard Marks quote: experience is what we get when we don't get what we want. And so everybody has to go through that sort of experience. Back to complexity and jargon, every profession has their own specific language. And I'm not the first person to make this observation. This has been well understood for centuries. The way you maintain a guild, so the way you maintain a expertise, is you hold the public at arm's length. You create a different language. You make it look much more complex than it really is. And now they have to come buy your services. And, anytime you go to a professional conference, even outside of finance, notice the degree of complexity, the specific language that is unique to that particular field. Finance does it a lot.
Barry, you're a storyteller, and it's really impactful. And I think stories are a great way to, you brought it to life, communicate messages. And in our industry, we are quick to tell stories about success and big wins. And I think it's really important, and I'd love to hear your perspective when you're telling stories, to share the negatives and the downfalls and the pitfalls, to bring the concepts and the challenges to life. And I'm curious, when you see the media out there kind of only talking about the upside or scaring on the downside, what can we do as a profession to not only talk about these big shiny objects?
I love the concept of a cable or satellite channel focusing on gardening. And they have some cams where they're watching a tree grow, and eventually they sell it to a private equity firm that wants to generate a return. And so they rejigger the channel and they bring in a bunch of people to start arguing about the tree. Why'd you plant it here? Why didn't you plant it there? It's too deep. It's too shallow. Too much water. What about, big pesticide is suppressing us, and all this nonsense. And they're just constant bull bear arguments about the tree. And this goes on for months and months and months. And the whole time, nothing that's said affects the tree. The tree just quietly keeps growing. And that's investing. Is go back to where we began. If you don't need this money for 30, 40, 50 years, or even if you're in your 40s and you don't need it for 25 years, what happens on any given Wednesday afternoon is just not relevant. And the problem with financial TV, which is very loosely based on a football game with, here we're at the halftime and here's the game wrap up, and a football game or any sporting event is usually over. With football, or basketball, it's 48 or 60 minutes. With baseball, it's 9 innings. But there's a finite amount of time. It doesn't go on ad infinitum. And at the end, you have a score, and who made good choices, who got lucky, and who won or lost. Markets are not that way. And so why are we treating each day's activity as if it's a football game with a final score? I mean, I guess if you drop dead today, you have a final score. But other than that, the sort of noise around investing is just this immense distraction from investing, the fire hose of noise. And my solution has been you have to, first of all, financial television should be appointment viewing. So if you find people you really like, well, go find them on YouTube and watch what they have to say when they say it. You know, I love Art Cashin. He just passed away fairly recently. I used to watch Art Cashin by finding the little clips on YouTube, and 90 seconds of here's a guy who's been on the floor of the market longer than I've been alive. And what Art has to say is always informative and insightful. And extrapolate that, media it's the daily beast that must be fed, right? You have so many inches of columns for newspapers and magazines, 24 hours a day for TV and radio. The internet is theoretically infinite. It never stops. But you don't have to read everything. In fact, you should create your own all-star team of people who didn't just get lucky once with a wacky outlier call. You want to create your all-star team of people who have a defendable process, have been there through several cycles, who understand what's going on, who have a good track record in explaining things. They don't even have to have a forecasting record, because the best of these people don't think in terms of forecasts. They think in terms of probabilities. And I could give you, and
you do in the book, right?
Yeah, I give you a list of, hey, create your own team. Here's my team. Every person I mention, whether it's Torsten Slok or Ed Yardini or Ed Hyman or Sam Rowe or Jason Zweig or Morgan Housel or like Ben Carlson in my office is also on my list. Like all these people, and there's another, lots and lots of people. One of the things I used the book for was a way to just kind of thank the people who helped shape my outlook and have, whether they knew it or not, they were mentoring me over time. Some of them I've been fortunate enough to get to meet and like Danny Kahneman, or really know, like Michael Lewis and Dick Thaler. I say I have the greatest side hustle in all of finance. Once a week, I sit down for 90 minutes with some of the most interesting people in the world, whether they're Nobel laureates or billionaires or just fund managers. And I get to, who are you and how'd you get that way? What can we all learn from you? I'm just a giant fan of finding people who have proven that they are not just a little bit, but enormous value add, and being able to work with them as, all right, I'm not, by the way, none of these people tell me buy this, sell that. I'm now actively trading the portfolio. But what they do inform you is that most people's worldview, most people's 360-degree view of their world and finance and what's happening in the economy and all these other things is deeply, deeply wrong, because it relies on a lot of speculation and opinion and predictions and not hard and fast data. And that's my biggest takeaway. It's not that the media is wrong. It's that there's a fire hose of good and bad stuff, and separating the wheat from the chaff is something that most people don't do, but really should. Sometimes some people get it right. Sometimes they get it wrong, but there's a small group of people that have so consistently added to our understanding of what's going on right now. Forget next year, or not only right now, also a lot of people still don't know what happened last year. So we're recording this in, 2025. Every post-mortem of the election in 2024 is just a wild exercise in hindsight bias and recency effect. And they're just bereft of any real insight. And the whole concept of, hindsight bias is, once you know how the movie ends, once you know what the final score is, you can't go back and imagine what it was like beforehand, Laszlo Barigny, who's another one who's no longer with us, his firm puts out a book every year that's all of these headlines and newspaper stories about markets, about the economy, what have you. And what's so fascinating about them is when you look at news when it's old, it's not that it's factually wrong. For the most part, the Wall Street Journal, the Washington Post, the New York Times, the major media, the LA Times, the Chicago Tribune, they get the facts mostly right. But after you know that we don't have to wash our groceries if we don't want to get COVID, once the dynamic tension is removed, suddenly you start to notice, wow, there's a lot of emotionality in these headlines. There's a lot of hair on fire, but that hair on fire goes away when you know, oh, we made it through the COVID, or at least most of us did, made it through COVID and these histrionic headlines. You can see how people make bad emotional decisions because even if the facts are right, the tone, and that's the first thing that leaps off the page, leaps off TV, leaps off radio, is the tone. I remember during the financial crisis, I think Maria Bartiromo was still at CNBC, and you could hear from her voice the exact amount the market was down that day. Like her voice was here when it was down 0.5%, and it was here when it was down 1%. And then she was just shrieking and waving her hands when you're down 3 or 4%. And it's like, it's kind of amazing to recognize what a pernicious influence and what's even worse today. So Instagram, Twitter, TikTok, especially algorithmic social media. And I distinguish algorithmic social media from everything else. If you go to Blue Sky, who you follow is who you follow. Nothing bubbles up. If you go to Twitter or Facebook, they want to keep you engaged. And the best way to keep you engaged is to piss you off. There's this outrage industrial complex. And I don't just mean, Fox News and MSNBC. I mean, algorithmic, and they're really, really good at this. And they've been using AI for a long time. And so, I could talk about this forever. I don't want to go too far down a rabbit hole, but if you do something because of something you read or saw on any social media, any algorithmic social media, the odds are that you're going to end up making a mistake, whether that's invading the Capitol on January 6th or selling everything in the first quarter of 2020. Social media turns out not to be an aid to good decision making.
So true. Let's get personal. How do you describe your relationship with money today?
To me, money is a tool, right? I don't think people really understand this. Money is a tool that, not to get corny with Maslow's hierarchy of needs, let's assume you have enough money so that the basic security is covered. Money allows you optionality. It allows you to do things. It allows you to not spend time doing the things you hate. So I talked about, I hate doing my taxes. I will pay someone to do my taxes. I used to like mowing the lawn. I did that as a kid. I was a paper boy. I mowed lawns. I shoveled snow, whatever I could do to earn a couple of bucks. I got better things to do with my time. I used to work on my own cars. I don't really do that anymore. I don't have the time, and the technology has mostly advanced. I don't have but it allows you to do things that you might not have realized that you can do. It frees you up from wasting time. Money buys time. It potentially buys experiences. It allows you to affect your friends, family, and favorite charities in a way that's positive. If you have a healthy relationship with money, you understand what it can and what it can't do. I think back to complexity and making things understandable, you want to make things, and I don't know I'm stealing this from someone. You want to make things as simple as they can be, but no simpler. And we all have a tendency to grossly oversimplify things. So just look at the history of people's relationship with money and happiness. So does money buy happiness? Well, first, money chases away the lack of money blues. Clearly, that's a factor. And you could do things with money that perhaps bring some degree of happiness, Sahil Bloom has this wonderful quote I really like. Money isn't everything, but it can't be the only thing. And, having the options, having the flexibility to take your family on vacation. I hate the spending scolds that say never buy a new car. And I actually said to someone, how come you hate your family? What do you mean? Why are you driving a 20-year-old shitbox? So why don't you have the latest, greatest safety features on your car? Why don't you have seatbelt tensioners and blindside warnings and lane departure warnings? Where we live is kind of wooded and there's a lot of wild critters out. And I've taken every high performance driving school. I consider, you ask a room full of people, how many of you are above average drivers? 85% of the hands go up. I can very confidently say I'm an above average driver. And here's the 5, driving courses I've taken to prove it. A deer leaps out in front of me and the car slams to a stop before, your brain is like, you can't even react. And the car stopped before we plowed into this deer. We were only going about 20 miles an hour. I never would have reacted that quickly. Don't you want that technology protecting your family? So those are the sort of things that the smart use of money can buy. It creates not just security, but freedom and options. It frees you from doing the things you don't want to do. And it allows you to do the things allows you to spend your money in a way that is both useful and beneficial. It's not the only thing. It's not going to make you happy alone. There are a lot of you need to be satisfied with your job, and you need to feel like you're useful and productive, and you need to have healthy relationships. And there's, go down the list of all the things that the happiness studies, and there's tons of happiness studies, tell us makes us happy. But money gives you some options and some choices, which you will notice. If I noticed when I did not have those choices, and it did not make me happy, those lack of options.
Barry, do you have a financial advisor?
I have 30 financial advisors. I work with a couple of people in my office on our taxes, on my own personal finances outside of the market. And everybody in our office eats our own cooking. So all of the firm's portfolios is how I'm invested. I'm the chief investment officer. So the conversations I have with people are more about what I'm doing around outside of the portfolio. The portfolio, I just let it do its thing and I kind of stay out of its way. It's everything else. It's tax planning. It's estate planning. It's things along those lines where working with a financial advisor really makes a huge difference. And, I mentioned you should have an all-star team of media people whose insights you trust. The same is true for professional counsel. You need a really good lawyer who's seen whatever you're going to go through before so they can give you good advice. You need a great tax accountant. You need a fiduciary advisor who's going to make sure your interests come first. And you also need a good GP, a good doctor who, if you need to be referred out to a specialist, has a good network of people they can plug you in. Putting together that wise team of counselors, absolutely crucial. So I have more than a financial advisor. I have a team of professionals helping me make decisions about the stuff that I don't want to think about my taxes. I don't want to think about, oh, wait, I have to start drawing down on this. When do I take Social Security? Do I really need to start thinking about that? I'm early 60s. Why am I even talking about that? But you need people who are experts in that space and can keep you on this right path.
We agree with you, and we appreciate you as a financial professional sharing your own experience with us. We think that's really important, especially as we talk about all these money mistakes and the importance of having good counsel that's objective by your side, helping you make decisions based on who you are and what's most important to you and what you're trying to achieve with your own wealth. So thank you for that.
Oh, my pleasure.
Barry, what's your next money conversation going to be, and who's it going to be with?
So I never know what my next money conversation is going to be. I can share my most recent one, which was yesterday. But I never know what client's going to call, what advisor conversation I'm going to have, what media person's going to ask a question, what a family or friend is going to ask. But if this works for you, let me share yesterday's conversation. So a good friend was working for a startup, and he has gone from firm to firm to firm, and he seems to, wherever he goes, that firm gets bought. And a conversation a few years ago is, hey, maybe this is kind of a heads up. You should have some equity wherever you go. Take less money and more equity. And he's like, yeah, I reached the same conclusion. So some time ago, the firm got bought, and it gave him enough of a windfall. So it wasn't enough of a windfall that he never had to work, but it was enough of a windfall that he could be really choosy at the sort of work he would do. And when we were talking about the future, the conversation touched on a few things. One thing was back to what makes you happy, what brings you joy. What do you really want to do? Like, we all end up doing things in our jobs that we don't love. And that's because most of us work for a living and we're not free to not do that. But he kind of had that wiggle room. And he's young enough that he can't just tap out, and he has no interest in retiring and playing golf. He still has another 10, 20 years of a career left. So I recommended he take the Hollywood auteur route, which is, if you're a well-regarded actor, director, producer, and you're not quite done, but you want to slow down a little bit, you can be a mercenary for this movie, and then, meaning like a Marvel big paying, tentpole movie. And then the next movie, you could do a little indie, Sundance premiere sort of tiny, no real salary movie, but you loved the script and you really loved the co-stars you'd be working with, and you alternate. So what that means in finance is do a consulting gig for this small little startup company that you like, and alternate that with a mercenary relationship with BlackRock or Goldman Sachs or whoever's going to write like a stupid check with a lot of zeros because you're an expert. By the way, if I told you his name, you would know it. A well-regarded expert in the space that could command, six-figure consulting contracts. It's like, I don't want to go work for a big, $1 trillion shop. That's not what I'm looking to do. And I'm like, yeah, but you can't do the indie movies exclusively because you'll go hungry. They're craft services. There's no food, literally no salary, no food. So alternate with occasionally being a mercenary and taking a big check, and then go work for, I'm not telling you to do terrible things. You're working for legitimate companies. You just don't want to do that work, but you could do it for 3 to 6 months and bank the next 2 years of expenses, and then work with a couple. So that was the most recent advice, which was, hey, you don't do something just for the money. And if the money allows you to do other things that you otherwise couldn't afford, there's a nice balance to be found there.
Thanks for highlighting such an important money conversation. And that's why we encourage it. It really helps each other see beyond what we know and how we think. Barry, where is the best place for our listeners to find you?
So they could go to the website, Ritholtz.com, and that'll link out to everything. It links out to the podcast, to the How Not to Invest book, to Ritholtz Wealth. That's my hub. Or on Bloomberg Radio is my the most fun I have all week is showing up and sitting down with some really amazing people and finding out how they got that way. Yeah.
Your podcast, Masters in Business, is fantastic. So is your new book, and congratulations, How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth, How to Avoid Them. Thank you for joining us and sharing so much on Money Tales.
Oh, thank you so much for having me. This has been quite delightful.